Hey, fellow traders. Before we get started in the overall portfolio idea that I'm going to be starting this coming week, I need to cover a couple more topics. One of the main topics that you're going to deal with when you're actually trying to trade with multiple pairs is something known as correlation. And basically, what that means is whatever one pair is doing, if it has a negative correlation, such as the case of what I've got pulled up on screen here, is whenever one pair is moving down, the other pair is probably going to be moving up. And this can actually work to your advantage or against you, kind of depending on how you're looking to trade. Basically, though, if you were looking to make sort of a portfolio setup, or there's actually another setup that this is a part of that I'll get into in another video, actually the next video, so that way I don't make everything too long. But for the most part, the correlation is going to help you in the effect of two-pair hedging. And if you're making a portfolio, you more or less kind of want to avoid pairs that would do correlation, although sometimes it is kind of hard to avoid that. But a lot of times this is commonly used to kind of read one chart to trade another pair, or to try to hedge with a two-pair hedge setup, and that's what I'm going to talk about in this video. So this would be considered more of a proper hedge, and it basically just takes two pairs to do so. The first thing you're going to want to do is find a pair that kind of moves in the opposite direction of the way that your main pair that you're trying to trade is moving. So if you were, for example, to trade the Euro USD, we notice that it's kind of in an uptrend, and it looks like if this is making an uptrend, the correlation of the USD CAD is usually a -1, but not always, and I'll show you a way to find out what that is real easy in just a second. But if you're trying to make a hedge, and say for example you had this short and it started moving up, then you would also take the same direction trade on the CAD, the USD CAD, and you would target uh, enough distance to where you would cover where you may potentially cut out this loss, and vice versa. So uh, one tool that can make everything very easy, just go up to trading view and indicators. This is actually a built-in indicator. You just type in CC, and this is actually called the correlation coefficient. And when you click on it, you'll just have to put in a symbol. If we're trading the Euro USD, for example, and we would want to use the USD CAD to check and see if we were going to use that for a hedge, for example, then you just type in USD CAD, hit enter, and apply, and then it's going to add this to your chart here. And basically, it's not really so much as an oscillator, it's just limited to values between -1 and 1. It will not ever go over -1 or over +1, because this is just basically what it means is if you're at -1, that means they are moving 100% opposite to each other. So for every move this goes up, the CAD will go down. And then if they're at 0, that kind of means there's no correlation at all. So even though this is making a strong uptrend, this is kind of consolidating and flat. You'll notice that it's kind of near the 0 line, but it does typically drop to the negative side. So if I'm expecting the euro to go up in this example, and I want it to kind of double up, which is kind of what I've done here, but it's not really so much as a double up, which I'll get into in the next video. Because it does go a little bit deeper with hedging than just beyond one or two pairs. So we'll get into that on the next one to keep this one from getting complicated or long. But as it's going, let's say for example, we were going to short here instead of long, in the case of doing a different setup, then what we would actually do is if we were price started to move up on the euro, then we would also want to sell on the CAD, because then we would expect that if the euro is moving up and against our position, we'll need to place another position on the CAD in the same direction, and this way it will actually gain on the account to cover what the drawdown is actually occurring on the euro. So this would be considered a two-pair hedge, and it's one of the more basic ways of actually setting up a hedge, and it would actually be a more proper way to do so. You could also adjust your size a little bit on one pair or the other. So if you are already in one lot, or you know, 0.01 or 1,000 units, what I have set up right here, and you wanted to, it was for sure going to go down on the CAD, then you could actually kind of go to 1200, 1250, or 1500, and go a little bit higher on the CAD, and it would actually make a little bit more than what you're losing here and still kind of gain on the account. The only downside is if you do start to get that wrong, it could go double against you. So it's kind of better to try to balance these out between the two pairs, and then try to find targets to where if you were definitely going to cut that out, then you would definitely cut out this as well. So you would take a $20 loss on the euro and a $20 gain on the CAD, and it would balance out minus your commissions. So that's one basic way of looking at correlation and using that for a two-pair hedge. And if you were looking to set up a portfolio, for example, of what I'm about to get started, I'll include the link for that. Then you'll want to try to avoid any type of -1 correlations, or if you are trading it, you'll want to try to trade the same direction, but then you'll have to mind your risk management, because then it is sort of like a double down. Uh, so it would be kind of similar to putting 2,000 units on the euro, but as I was talking about before, we have a little bit of a different setup on what's going on here. I actually have this tied between three pairs, and that's something a little bit more common. It's kind of a slower way to go, but usually kind of does work out in your favor over the long run. It's a little bit safer way to work with it, so we'll take a look at that in the upcoming video. And the main thing is because it's a little bit has a little bit more complication to it to try to explain, because it's working between three pairs, and it actually does involve the correlation. But for keeping this video kind of short and simple, uh, we'll just refer to looking at everything as a two-pair setup and kind of work with that. You could, one way you could kind of plan this ahead of time, if you don't have, like, for example, a clear target that's kind of evenly matched or so, and you need to kind of work out your size, you could actually add, it's labeled the Scalper's Toolkit on my profile, but you could actually load this up as a risk calculator. And once you go through and set everything up, you could actually set down, scroll down to the very bottom and set your lot size. It's only working in lots right now currently, but you can, like, for example, if you were to do 1500, you could type in 0.015 and it will work out the units that way. It will accept that. And then I'll make it a little bit bigger so we can actually take a look at it. And then this will actually show you, so if you were to set up your target, for example, so say if you were looking to set up 100 pips for the distance, then you would actually could set that to 1-to-1 to check the target size, and then just set this to fixed size. So we would actually see, where is our profit? So there we go, the stop and profit amount, and then you could need to set this to 100 points, 1,000 points for 100 pips, sorry. And then we should be good to go. There we go. So now we can see that if we're using a 0.01 and we're traveling 100 pips, and we were to measure this out to see where about 100 pips would be, then we would be somewhere right around in here, which might be a potential target, and that would work out to be about $11 for that size. But if we were to go and pull this up to use a little bit larger size and go with a 0.02, for example, that would increase the value of it by increasing the pip value. And that's how you can kind of shift the balance to work one way or another if you have a clear direction, but you want to continue holding that as a hedge, just to kind of reduce the losses. And then potentially when it does start to reverse again, then you would exit out of the CAD trade and let the other trade on the first pair continue and regain its losses, and thus also put a gain on the account overall. Because when you start hedging, that's when you're actually looking at your overall account balance and not your actual trade to trade balance, because all the trades will essentially work together, one assists the other. And on the next video, I'm going to get into another topic, and I'll actually get that uploaded pretty soon, because I need to get that out before the weekend and before we get started in the portfolio. But we're going to talk about a little bit more complex idea with this. So if you want to take it further, then just be sure to catch the next video. For most entry-level trading and for most interested in hedging, this is one of the most common approaches to actually do it properly. It also works on USA-based accounts, so you don't have to have multiple accounts or dual accounts or different brokers or anything like that to work around any rules. And one thing to note, that if you do uh, decide to use techniques such as averaging in, it's probably a good idea to use a unit-based account unless you're trading with a larger account size, because you have to deal with the first in, first out rule if you're in the United States. And basically what that means is whatever trade you open first is the first one you have to close if you open other positions. So one way to work around that rule, because the main caveat of that rule is that positions have to be the exact same size. So if you open two positions, one here and you had another position, say, for example, here, then you would have to basically, if you open this one first and this one second, and this one was in profit, but then this one was in a little bit of a loss, and you wanted to just take that off to reduce the risk, you would actually have to close both of them and reopen another one. But if you had a position here that was 1,001 units and this is 1,000 units, you would be able to freely close either one of them, and you'd also be able to place a stop loss on both of them. So if you were looking to use a stop loss in your trade, and you had multiple positions set up on the same pair, same direction, you can make them slightly different by 1 unit, and you'll be able to freely close them at any point in time. You won't be subject to that first in, first out rule. So just a couple of tips to keep in mind if you're looking to hedge and average in as well, instead of close out and then size up. Because sometimes you may want to put a 0.01 here, a 0.01 here, and a 0.01 here, just in case it reaches up and then starts to drop, because it does clearly look like it might be making a head and shoulders, or could be making a pullback to continue a downtrend. So right now it's kind of looking like it's consolidating. I'm just kind of expecting it to go to the bottom. So that's kind of the setup behind that trade. And I'm also looking to trade this the other way, and I've got one other pair set up, which we'll talk about here soon. That's kind of protecting both of these positions together. So we'll get into that in the next video. But for now, just take a look at some of that, try to find some other pairs. Also, if you find some that are in a positive correlation, that will mean they are moving in the same direction at the same time. And a common technique is to use like an index of the country for the primary currency that you're trading. So like, for example, if you're trading the Euro USD, you might want to watch the S&P 500, the Dow 30, or you may even want to watch QQQ to observe the overall NASDAQ action. Just make sure it's the positive QQQ and not the XQQQ, which is negative. But basically you would take a look at that, and it would be kind of the whole idea of one pair would lead the other. So the index might take off to the upside as the euro is kind of consolidating, and then shortly after the euro would start taking off to the upside too. Usually one pair would lead the other. I know the DAXI is a common one to use, especially with the yen and the euro and the sterling. So just check some of the, especially like the Nikkei with the yen, the pound, and London. They use DAXI and a few different other indexes will come in handy depending on which pair you're trading. So, like if you're trading some exotics, you may want to check the stocks in that country specifically to kind of see an overall feel of what that country is doing. And you could also even check the base pair to see where that is going as well, because that could give you an overall idea of the long term market outlook. If one index is on the rise, then of course that part of the currency in that pair will get stronger. So that will affect it. And if the euro and the USD are one's getting weaker, one's getting stronger, it's going to make a strong effect to a trend. So just something to kind of look for in extra details if you're looking for a long-term outlook and a way to kind of set a long-term price target. That's kind of how the banks are looking at it. So I'm going to wrap this video up and try to get the next video out before open of market tomorrow. And then I'll go live with the account with the setup and go ahead and make the first trades on that. So stay tuned and I'll catch you on the next one.